Have you ever looked at your chart and felt like it's a tangled mess of support and resistance lines? And what's the result? You still get stopped out, over and over again. Forget all that. Stop drawing random lines. In today's video, we're going to completely blow up those outdated textbook theories. Buckle up, because I'm giving you a razor-sharp weapon. The secret to identifying true supply and demand zones for high-probability setups. Everything I share today comes from real trading experience, meaning you might hear some concepts that completely go against the retail crowd. Ready to level up? Let's go! Part 1. The core concept, bulls versus bears. Let's clear up the definitions first. Supply simply means sellers are pushing into the market. Therefore, a supply zone is a price area in the past where sellers took absolute control, often represented by previous peaks or broken valleys. Conversely, demand represents buyers stepping in. A demand zone is an area where buyers previously dominated, which could be previous valleys or broken peaks. A lot of people call these support and resistance or key levels, but honestly, those textbook terms don't reflect the true nature of the market, the brutal battle between buyers and sellers. It's much easier to visualize if we call the demand zone the bull zone and the supply zone the bear zone. The name doesn't matter. What matters is understanding the dynamic of the money flowing in. Part 2. The retail trap, drawing meaningless lines. Here is the biggest mistake beginners make: drawing horizontal lines across as many peaks and valleys as possible. Because there are no strict rules, you'll constantly second-guess whether you should connect these two bottoms or those two bottoms. If you draw every possible line, your chart will look incredibly messy, making it impossible to actually trade. In fact, here is the harsh truth. If you close your eyes and place a random horizontal line anywhere on your chart, it will inevitably cross some random peaks and valleys, looking like a valid support or resistance level. Relying on this flawed method is a massive mistake. Part 3. The pro rules for mapping zones. So, how do we draw zones correctly? You need to follow these 3 core rules. Rule 1. Focus on current price. We only pay attention to the zones closest to the current price. Our goal is to find good entry points to trade, not to be chart artists. If the price hasn't even reacted near the closest zones, drawing distant zones is completely useless. Rule 2. Zones are relative areas. A zone is not a single fixed line, it's an area. You can draw it using wicks, small candle bodies, or 2 close reaction points. But the best way to start is by taking the highest or lowest extreme point of a peak or valley to mark your zone. For visual clarity, color your bear zones, supply red, and bull zones, demand green. Rule 3. Momentum is king. This is crucial. The strength of a zone depends on the momentum, the explosive move that originated from it. Look for areas where the price dropped massively or pushed up with extreme speed. Those fast, aggressive moves indicate a very strong zone. Part 4. Real trade case study, XAU USD. Let's look at a real multi-time frame case study on the XAU USD pair from this past week. Step 1. The 1-hour chart, H1. We clearly see a massive bullish wave that broke through previous resistance zones. This momentum confirms the buyers are in control. We map out our potential demand zone here. Step 2. The 1-5-minute chart, M15. We zoom into M15 to refine this zone so it perfectly encapsulates the accumulation candles. The bias is extremely clear. H1 broke out upwards, and M15 is maintaining a bullish structure. Our only plan is to look for buy setups in this zone. Step 3. The 5-minute chart, M5. The price pulls back into our demand zone, but remember, no blind entries. We drop to M5 to watch the price action closely. After hitting the zone, the price creates a small bounce and then forms a consolidation phase. Suddenly, a strong candle definitively breaks out of this consolidation. Step 4. The entry. That breakout is our perfect entry signal. We execute a buy right there. And what happened next? The price rallied aggressively, hitting our take profit target perfectly. A highly successful textbook trade using supply and demand. Trading supply and demand, or bull and bear zones, is all about understanding market imbalance. If you found this video helpful, smash that like button and let me know in the comments what topic you want me to cover next. Therefore, you must know how to identify the correct and strong supply and demand zones. To determine which zone is strong and which is weak, we will primarily consider three criteria. First, it is important to see how much time the price spends in a zone. Here, you have a supply zone on the top and a demand zone below. The market moves upward, forming a strong bullish candle. And after forming a small indecision candle at the top, it reverses from here with red bearish candles, which creates a supply zone on the chart. Here, the market has come down sharply by forming just one candle. Hence, we will call this supply zone a strong supply zone because the sellers have completely dominated the buyers here, and they are very interested in selling the price from this zone. Similarly, the price comes down with strong bearish candles but reverses suddenly from the lower level. It happens that the price has reversed here after spending very little time. Hence, we will call it a strong demand zone. In another example, the price spends more time in the supply zone than before and then comes down. This means that there has been a little fight between buyers and sellers, in which the price has come down due to the sellers dominating. Hence, we will call it a standard supply zone. Similarly, while going down, the price stays in the demand zone for some time and then reverses and comes up again. Therefore, this is also a standard demand zone. In the third example, the price spends a lot of time moving up and down in the supply zone by forming small candles and later comes down. This means that due to the equal number of buyers and sellers, the price remains balanced for a long time. And finally, due to a slight increase in selling pressure, the price goes down. Therefore, we call it a weak supply zone. Similarly, the price spends a lot of time in the demand zone, due to which this is also a weak demand zone. Let us now see the second criteria. Here, while the price reverses from the supply and demand zone, it forms strong momentum candles. This means that in both these zones, the sellers and buyers are in a very strong position, and hence such momentum candles are formed on the chart. That is why we consider such supply and demand zone as strong zone. But here in the second example, while the price reverses from the supply and demand zone, a normal sized candle is formed. It forms and moves forward at a slightly slower speed. Hence, we will see it as a standard supply and demand zone. At the end, the price falls below the supply zone and forms small red candles, along with some green candles in between, which means that sellers are not very interested in selling from here, due to which the price comes down slowly. Hence, we call such a supply zone a weak supply zone. Similarly, when the price moves upwards from the demand zone, so it comes up by forming small candles, due to which the price takes a lot of time to come up. Hence, we can call it a weak demand zone. If the price reverses after retesting any supply and demand zone for the first time, then you can enter a fresh trade here in the direction of reversal. However, if the price retests the supply or demand zone more than once and tries to come back to the same zone again and again, then it signals a weak zone. At such times, you should always avoid entering a trade in the direction of reversal. You can also use all these criteria to know which zone is weak and which is strong regarding the support and resistance zone. Let us now know how to enter a trade in the demand zone. This is the 5-minute time frame chart of Bank Nifty dated March 5. Here, as soon as the market opens, the price forms a big red candle. This kind of price action forms on the chart. Here, the market is consolidating in a small range. Till now, the price has not given a successful breakout on any side. Here, the price tries to break this zone, but no candle closes above this zone. Hence, we will not enter the trade here. After some time, the price once again moves up, taking support from below, and a small bullish candle is formed above this zone, but does not break the wick high of the previous red candle. After some time, when the price again rises, then the chart but a 3 inside up candlestick pattern is formed, which is again a bullish candlestick pattern. Here we have 2 bullish signals, higher low and 3 inside up candlestick pattern. However, the price has not yet broken its previous high. Therefore, we will not enter the trade until a confirmation candle is formed on the chart. As soon as the next candle opens, sellers push the price down, but buyers enter the market, due to which a hammer candle is formed on the chart. Now, we can enter the trade on the closing of this candle. in which we will have to place our stop loss below this swing low. After some time, the price moves upwards and hits our target with big bullish Maru Boju candles. Here, if we had entered a long trade on this green bullish candle with impatience, our stop loss would have been hit, due to which we would have exited the trade. If you want to become a successful trader in Forex market, then you will have to wait for the market to reach your correct trade entry point, because unless you make your psychology strong in the market, you cannot survive in the market for long. If you liked our video, then please like the video and subscribe to the channel. Thank you.